All right, what's going on, everybody? What's that? Short week, huh? So everybody, you gotta prepare for that with your trading analysis, setups, evaluation, all that good stuff, right? Because it will affect odd ways. Seems like the live stream is streaming. All good. Along the way, if you guys have anything you want to look at, hit me up. We'll detour and take a look at it. Otherwise, I had some requests to talk about scanners, and it's always a good topic. It's good for experienced traders, new traders. I mean, everybody can get into finding something to trade, right? And scanners are probably the number one reason why it's even worth learning indicators, as far as I'm concerned. I don't trade with indicators. They are not the signal that I use to get in or get out. They don't give me trade triggers or any of that. So, when you kind of think about what's the use of an indicator if you're not going to use it to trade, I, I really like using indicators with my scanners to find things that are setting up or that just have conditions that I'm looking for so that I can see what shows up in the list and then kind of go from there. They're great for analysis. And so, the whole argument about having indicators or using indicators, I think I'm a better trader just, because I took the time to learn about some of the indicators that are out there, at least the most popular ones. And there are good indicators, like cumulative delta. I mean, that's an indicator and it's really helpful. I don't necessarily say that it's a trade trigger, but I mean, that's at least an indicator that I've used as a signal. And then because of it, I've taken trades after it got my attention. And then I went in and found an opportunity. So blanket statements like indicators suck, well, that doesn't do anybody any good. Also, it's like a gauge. I've often said, when it comes to indicators, it's like looking at the speedometer on a car. Yeah, you can get in the car and you can tell that you're going slow or going fast. But if you get pulled over, you need a better argument than I didn't feel like I was speeding, right? If you can say, no, I was looking at the speedometer and I wasn't going too fast, you've at least got an argument. Same thing with the markets. We can say, yeah, there's trend. Yeah, there's momentum, but how much trend or how much momentum? And is it increasing or is it decreasing? So, being able to put a number behind it and evaluate whether something is increasing or decreasing and by how much gives us a gauge to go from. So, indicators have their purpose. And to me, that ties right into scanning. What we're looking at right now is US 30, JP 30 on the left side of the screen, ES on the right side of the screen, and the buy right monthly index in the middle. These are all on a 5-minute chart. They should all be moving in the same direction. They should have very similar charts. The fact that they don't tells us that we've got something out of whack. The one in the middle, since it's options, is the one that I use because, well, most of the time price gets bullied around by options. So you can turn on, spot gamma and trading ticks and all those really fancy, expensive tools, or you can just turn on this free product called BXM, Buy Right Monthly Index. It is generic, so it's not looking at one particular market like the Qs or SPY or something like that. It's looking at anything that has options in the entire broad market space. And are those calls that are bought or puts that are bought. That's a really generic way of looking at it. So when it's going up, options are being traded in a bullish way, and when it's going down, options are being traded in a bearish way. So if I see price going up, I want to see the broad market participating in that price push in the indexes with long options. Really, it's as simple as that. But if we have a situation like today where we've got options up and we've got price up, but we don't have US 30, JP 30 up, then I know that something's wrong. Treasuries are not helping. And that's okay, right? We don't need everything. We can have discrepancy within the tools that we use, but long trades tend to do better when everything is going along with us, when we've got treasuries helping us out, options helping us out, maybe news, right? But none of these are looking at news, so that we can try to determine, hey, what's pushing price around? It doesn't mean we're actually going to get an answer, but when we do have the answer, life's better. So we've been topped out, and I was watching this before I went to stream live, wondering if we were going to get that breakout or not. And seeing US 30 JP 30 fading down after that high from way back here at 11:40 in the morning. Since then, we haven't had any help from treasuries, and it doesn't look like we're going to get any either. If that don't turn around, the breakout is going to have to come from something else. It won't come from treasuries. And it can come from options, but you see options tried to break us out. It didn't stick. So if it's going to come from options, we need a much bigger push. And so far we're not getting it. It's stalled out. Now this, as I said, it is generic options, and we could get a more sophisticated push from dealers within the SPX or the QQQ, but we wouldn't see that here necessarily, right? This is like a rising tide that lifts all boats, right? Instead of jacking one particular boat up out of the water. Broadly speaking, if the S&P was to break out, I'd want to go long when I saw that everything else was going long with me, right? So that's kind of what I was looking for here. I think Microsoft's getting ready to take a break, but this thing could just keep running right on into earnings. I'm of two minds on all of those Mag 7 guys after all the hard work they've done. One is, and we've seen this before, we get a run into the new quarter, and then since new quarter kicks off with earnings, that we're going to fade now into the earnings cycle. Because you can see how we ran from the last earnings all the way up to where we are now. And then we stalled out right at the end of the month. And if you go back to the previous earnings, we had a gap down and we ran the whole time into the new quarter. And then what happened? We got into the new quarter and we changed the direction before that earnings. Kind of the same bag in the other direction, right? So I don't know. At this point, trying to go long in Microsoft or any of the others after they've had that sort of a run, I'm really not that interested in a long. And to go short, we don't have a short signal. So then you're just jumping on, wishful thinking, and I'm not interested in that. So I've been keeping my eye on it though, because that's a heck of a run. And really, the run started a little early. It started with this big gap up, not an earnings gap. And then it ran to earnings and then gapped up again. And then it's just been a beast. Meta, of course, made it back to the top of the zone. And now it's rejecting a monster with that one, too. So, one of the indicators I wanted to talk about today is an indicator that I learned about long ago, and it's called acceleration bands. There was a real famous trader back in the day. His name was Price Headley. And Price Headley was complaining about Bollinger Bands being too wide, and how after reading the creator of the Bollinger Bands book, how so many people were using Bollinger Bands in the wrong way. And so he wanted something that was a little more nuanced and would capture more of the typical market. So you wouldn't get as many fake outs and as many breakouts, and that when you did get them, as long as they continued in strength, then you continued to play it, right? So 90% of price action is going to stay within the bands. When we do leave the bands, that's when you've got strength, and you've got, extraordinary strength as long as we stay outside the bands. And that's a really good example of it. So Price Headley, if you was to search him on Google or look for some books, I think he's got some. Um, he really put a lot of work into this acceleration band, and you can use it on any time frame, whatever. It's just using standard deviations with a wider band, so it's going to capture most price. He didn't use this for reversals, like getting to the edge and flipping it around. He really only used it for these breakouts that held the breakout. And his logic was, yeah, you're probably going to take a lot of false trades, right? So, for an example, back here, we broke out and we didn't close on the breakout. So, we came back in. That would have been a fake trade if you tried to take it long. Or here on those 2 days, we did get the breakout and we closed outside the bands, but then we gapped down the next day, ran back up, closed outside the bands, gapped up, and then fell back in again, right? So that would have been another fake breakout, or back here, fake breakouts. So he says, yeah, you're going to get fake breakouts and you're going to get, you know, a lot of them consistently. But the ones that do stick often will be these movers that will go, weeks or months outside the bands. So after earnings here, Meta gapped up, was outside the bands, and the strength continued, and it just continued to run up those bands until finally it came back in again. Because of things like vertical spreads and butterflies, we can trade these really cheap. That way, if we are wrong, so what? We get a small slap on the wrist and we move on to the next trade. I know that that's not in a lot of traders' wheelhouse. When they're new to options and they hear me say something like, "Oh yeah, you're going to lose often," that just freaks people out and they don't want to even participate. But don't be scared of losing, right? Like losing's no big deal. It's how much you lose that really matters. So the whole idea of go big or go home, or that every trade has to be 5% of your portfolio or whatever big number you're using, it doesn't have to be that way. Tasty Trades has really beat the drum for a long time that you can trade small and trade often. That you can do the one lot king trade and just, run a bunch of one lots. 50 trades, one lot each, some long, some short, some sideways, spread out into different sectors and industries and, treasuries, commodities. Some of those are going to hit, some of those are going to miss. Every once in a while, you'll get a big blowout winner. But as long as you're running, cheap trades, you'll never get a big blowout loser because it can only lose whatever the max debit was to begin with. And that way, your account is going to continue to grow simply from forced error. You're going to get the occasional blowout win and be able to manage your losses simply because of low cost trades. Tie that in with things like this, where the ones that do stick and win get a really nice continuation. And then of course you can add other tools, or you could add news or a backdrop or thematics. That way it's not just one particular name, like, oh hey, I found, American Airlines is running. So what? But if it's, oh hey, I found all the airlines running, and oil's really cheap and crude is falling, well now we've got a reason to play, right? And kind of tuck things in there, have some background into what you trade. So I like the acceleration bands, and I thought they would be a good example to use today for scanning, just to kind of start the conversation about scanning. But obviously, it wouldn't end there. So if I wanted to find, say, a short opportunity, I could look for things that are outside of their acceleration bands so that I could start putting a watch list together of something like Meta, for an example, that is outside of its Bollinger or its acceleration bands, and that maybe has been outside of the bands for a long period of time. Because we can set the scanner to find things, say like 8 candles outside of the bands or 10 candles, whatever. And that wouldn't be a reason to short it just because we found it. It would be a way to develop a watch list because we would get a list of stocks. We could sort them by their sector, their industry, the reasons why they may be out of the band in the first place. And I like to find things that are extreme and then look for or wait for those extreme conditions to end. Generally speaking, I like them long so I can take them short, but you can do short to long too. The problem with that one, the reason I like long to short is because when you buy an option like a put, and then price falls, your put increases. But generally speaking, when price falls, volatility increases. And if you bought the put, that makes your put price increase even more. So if price is moving in the right direction, the option gets profitable. And then if volatility increases, the option gets even more profitable. And it's just like a win win, right? So I like taking the shorts just because the puts get the extra push from the IV jacking up. But you can take reversals, and buy calls. It's either here nor there. Plus, this style of approach fits my common approach. I like to buy puts when price is still going up, right? I like to buy calls when price is still falling. That suits me as a trader and it keeps my risk down. It's just the way I like it. So if I find a stock, say like Meta, where it was outside of the bands and for whatever reason, I'm ready to buy a put. I'm buying a put in a stock that has been extra accelerated to the upside. All the new traders are spending money like crazy to take this long, right? The paper hands, Johnny come latelys that showed up after this thing has been outside of this band for a month. And some new guy says, "Oh, is it time to go long now? Can I still get in?" Sure, why not? So I like getting those trades. That kind of fits. Another one that is fun to use is Heiken Ashi. I know a lot of people mistake this for price action, but it's not. It's an indicator and it just happens to look a bit like a candle, but it's not price action. So be very mindful of that. If you're looking at a Heiken Ashi chart, you're not looking at price action. These aren't real candles, they're fake, but they are an indicator. And typically, we'll call a trend change if we get two candles of the same color. So if we were red for more than two candles and we suddenly get two blues, we've got a trend change. Now, I'm not a massive Heiken Ashi guru, right? There's a lot about these things that I don't know. But over the years, I've come to appreciate them as a simple tool for scanning just to see, do we have two green candles or more, two red candles or more? And then I just bring up the chart. And generally speaking, I'm looking for reversals or indecision candles. Um, Dojis are really good, things like that. These things are a little weird when it comes to Heiken Ashi. I just picked this little bit of information up this week. I'm going to use these two bars right here. When it comes to wicks on Heiken Ashi, notice how there's no wick on the top side of these red bars and there is wick on the bottom of these red bars. Now, if we were looking at your typical average normal price action, these reversals or this wick down and then the run back up, that would be a really bad thing to see on regular candles. And I'm a regular candle trader, so every time I've ever saw that signal, I've thought, oh no, that's no good. In reality, what I recently picked up is that that is not a reversal signal in Heikin-Ashi. If you're, an everyday Heikin-Ashi trader, you knew that. But if you're someone like me who doesn't use this thing, then that's new information. So on Thinkorswim, over the years, I've collected different scanners, and along the way, I picked up some Heikin-Ashi scanners. I don't have them all. I don't have Doji yet. I'm working on it. What I what I did to start working on it is go back and find all my Heikin-Ashi scanners. I dug them out of the Thinkorswim toolbox, imported them back into Thinkorswim, and then started looking through what I have. And I found an indicator in my toolbox that was for quote no wicks. Well, I mean that's really all I need. Give me that much code, and I can reconfigure it to have dojis. But yeah, either way, so here's the Heikin-Ashi scanners that I have. Um, Combos, bullish and bearish trend. That's on the daily. Combos, bullish or bearish on the weekly. Just bullish weekly. Um, I'll say just bullish. It actually says uptrend, but whatever. Just bullish daily and then downtrend daily. I don't have downtrend weekly, but it would just be the difference of changing the time frame and then saving the indicator. I just didn't do it. So if we turn one of these on, I don't really like the combo ones. I only made them because there's always somebody who, says, "Can you just make them one indicator or one scan?" So let's look for bullish trend weekly. And I'm going to, I guess we'll set it and then see what we get. 92 names. That's a bit much. So let's tighten it up. Generally, I just use something like penny price to filter out how many names we get. My goal in running a scan a lot of times is the process of elimination. Everybody's got to have their own approach when you build a scanner. What are you trying to do? Are you trying to get names and you want as many names as possible? Or are you trying to eliminate names? And that's generally my approach. I'm trying to eliminate names. I want to have a small list when I'm done, and preferably like the cream of the crop sort of thing. So this narrowed us down to 42. And really, the only thing that I've added into this was that I want weekly and penny increments. So every name on this list should have weekly options, and those options should be priced in penny increment size. Now, if you're unfamiliar with Thinkorswim, its scanners really leave something to be desired, right? It'll bring you stuff that's just flat out wrong. It's not what you're looking for. And when it comes to my acceleration bands, for an example, that's 100% true. It'll say, oh, yeah, it just broke out of the bands yesterday, and then you go to the daily chart and you look and it's nowhere near the bands. It's somewhere in the middle of the range, and worthless, right? Just worthless. So, shop around if you can, find these scans on different platforms and see what you can get, or do them by hand. I like to go through, a select set of stocks like my AI list or my drone list, something like that, and just flip through them by hand and see what I find. So, the visual generally pretty good. So we narrowed it down to 41 names. These are all in a quote bull trend on the weekly, and that they have weekly options and penny increments. But 42 names is a lot. And when we try to define what made it bullish, right? Why is it a bullish trend with Heikin-Ashi? Bullish trend means that there was two colors, two candles of the same color. Well, that's not very much, right? And that's why there's a lot of names here. So let's go to Apple for an example. It just turned. We got two blue candles. Hey, and it's on a weekly, right? That's the other condition is a weekly. Boeing, two blue candles, Bed Bath and Beyond, two blue candles. You get the idea, right? Two blue candles over and over and over. If we flipped over the scan, it would be two red candles. But this doesn't really define bullish or bearish and quote trend simply because of those two bars. I mean, surely we can get more than that, but it's a good start, I suppose. We're gonna I got two here. The top one with the black background is the weekly. The bottom one is the same market symbol. It's just a daily. And I've got the acceleration bands on the daily here too. And you can see that the acceleration bands are getting tested here. But, be mindful that's not price action, right? That's a Heikin-Ashi bar, and it's not the real price. For the real price, we would need just your normal everyday chart, which, by the way, I called that reversal Monday on Apple. And then we went lower on the day because I called a long around $200.70, something like that is when we bought calls. And then we went sideways for half the day, and then it got a little uglier, somewhere around $199. But it's been on a tear since then. Those were 8 pennies each. That's a pretty cheap calls. We bought this Friday's expiration, the 212.5 strike, for 8 pennies. They are now trading for 83 pennies. 80 if we want to just, take the lower number. That's not bad. Spend $8, get $80. It's a pretty good run. I took that long um, with a dark pool print here. This bar, before we had, the price action on the day, we only had this much. We had that much right there. And I said, hey, I think we're going to go to this dark pool print and then we're going to turn around and go up. And so while we're still falling, I want to buy some calls. So I did on that bar. Then, we got down there on the next bar, but I was already in by then. And like I said, it did get uglier. So, it didn't look like we were going to have much fun, but it was 8 pennies. It was worth holding on. And, we reached the dark pool print plus some. And now we're turning around and going another way. Not bad. So we can combine Heikin-Ashi with something like acceleration bands. We can look for Heikin-Ashi signals like a Heikin-Ashi doji or HA candles with no wick on one side and then long wicks on the other for continuation. In these two bars that we're looking for, my thinking was if they're fakes, we're going to get two bars and then we're going to continue the move in the same direction. So I'd like to find something that fits that analysis. This is the bull scan, and there's just too many names in here. So another thing that we could do to filter it out is worth considering as well. All right, how can we filter it out and still not lose any of the good stuff that's in here? Trying to shorten this back up to where I could see both sides. All right. So when I'm trying to solve a question like that, usually I start looking for um, commonality between all the names on the chart. Because my goal right now is I've got too many names and I want to get rid of some of these, preferably by getting rid of something that gives me a signal that says, hey, you don't want to trade this. Because once I see that signal, whatever that signal happens to be, I'll know that that's the next thing I want to get rid of. And I can use indicators or code or some other thing to eliminate it from the list. So I'm just kind of watching the left hand side and I'm going through this list looking for something to help me reduce this list some more. This is a bullish trend. So if we find anything at the lows that are signaling a bullish trend, that may be better than finding something that's at all-time highs signaling a bullish trend, like Honeywell. You guys know Honeywell is deep into quantum, right? I mean, it's a subsidy of Honeywell, but still, it's Honeywell. So every time I see Honeywell now, I just think quantum. They've got a nice continuation above, 2.25. It's outside the acceleration bands, at least outside the Heiken Ashi acceleration bands. I'm going to see it on this other screen. I I just need price action. I can't help it. Both of those charts are HA, and I just need regular price. And I've got a daily and a weekly on another screen, so I can just add the acceleration bands onto that. What do you guys like to use when you're running scans? All right, so HA, what's up? You need one. What was your market cap? A billion? Right. That's good to have two numbers. Yep. I like that. When you said market cap, I remember I used to play around with market cap, and from time to time I still find some of my old scans that still have market cap in them. And when you said that number, I thought this is really cool. Let's see if we can find names that are under 500 million that we say, oh well, damn, that would have been a good one to trade. Except that we didn't see it because it would have never have shown up because it was underneath the 500 million market cap. Yeah, that's why. No, absolutely. The 400 week EMA that I use a lot, you just described it perfectly. I don't want some dog showing up in my scans. So if I'm looking for long-term trades that are good, solid companies, I look for things that are above the 400 week because I just don't want that trash. And I can tell you there are good companies underneath the 400 week that I would trade, but I would still look at it and say, yeah, it's trash. It's underneath the 400 week. You know what I mean? Like it can be both. I might want to trade it, but it's still trash because it's underneath the 400 week. These names that I just scanned for are less than 500 million. And I bet as we go through the list, you'd say, oh, well, I mean, yeah, I would trade it, but it still has a lower market cap and I would approach it with caution. But that's why I quit using market cap in my scans was because it was eliminating things like Blink or um, say KWeb, the China Internet ETF. And I mean, I use KWeb all the time for a tool. LAES, that's a part of drones. You know what I mean? Like, there's names in here. Jets, Mags, that's Mag 7. So I quit using market cap as a filter because of this issue right there. That there are names that I would have traded, but I never saw them because they were getting eliminated due to my market cap filter. I still like it though, because if you're looking for quality names, you're absolutely right. A good run company, generally speaking, is going to have a bigger market cap. And IPOs, if you're trying to eliminate, quote, new companies, IPOs a lot of times have that lower market cap too. So that'll keep those out of your list. Every scanner I've ever come across has issues with elimination. It will get rid of something that we wanted, but we sacrificed it anyways because otherwise the list was giving us too much of what we didn't want. So losing one or two names from the list was preferred as opposed to having to weed through the 30 others that it eliminated that we were glad it eliminated. So it's always a trade off. But the volume one, that's nice. I like that. That's good. Yeah, yeah. I think you probably missed it because you were very likely out of the chat. But earlier, I posted an update on one of my accounts that I run thematics in, and I have a artificial intelligence thematic theme that I'm trading. These are the five names that are in it, and um, so I was just posting an update since February 5, which is when I started this. The transaction history I've been adding in since the 5th, the February and then March, April, it kept going. But I've been putting trades monies into those, and I posted the charts that went with it. The returns, I mean, they haven't been bad, but those were the five names for my artificial intelligence theme. And in the other chat, well, in my coaching chat, we were talking about it in the main chat room. The other themes that I was running was brokers. We've talked about this one here in the chat, right? Trading CBOE, NASDAQ, ICE, CME. You could add Schwab, IBKR, Hood, and the new one, IPO Bull, which, to be fair, I probably should have at least put Hood and Bull on there, but I didn't. And the returns are okay. They certainly could have been better if I'd have added those. Another one is the Magnificent Seven, of course, right? The Mag 7 theme. But yeah, I like running themes. You kind of hit on something, and it happens a few times a year where the whole market is untradeable. It feels like, that we've run a long way and all the good stuff. And so we don't necessarily want to get in long in any of those things, but they're not shorts. So we don't want to short them. And then we're looking around and like, what the hell am I going to trade? I can't trade all the good stuff that's already run because it's already run. I don't want to go long, from these locations, yet there's no short signal on those. So I don't want to short them. And it just leaves us, kind of stuck and looking around. And I got to say, generally, when I get into this market environment, what I typically do is I end up trading options on futures because it gives something to trade. I can go put my money on something. And I just use those lines in the sand that are connected to time, like we've talked about before, to where I can say, do you really think the ES is going to, close below 59.50? And then I put a date to that. Do you think we're going to close, below 5,900 by August 1st? And if your answer is no, then now you know what put to go and sell. It really is as simple as that. Or taking it the other way around and saying, you really think the ES is going to close above 6,700 by August 1st? And if the answer is no, then great. Now you know what call to sell. Those trades don't necessarily pay out a whole lot of money, but because you're running them in naked options, they require a bit of margin. So it ties my money up. It gives me a trade so that I'm not just, making interest on my money. I'm at least making money, and it keeps me engaged and, keeping the money moving, offers profit. And those trades, because they're naked, are defendable, which is one thing that I always like to have when it comes to trades, especially trades of size that require a lot of capital or a lot of margin. Is that, can I defend that trade? And a naked option is the most easiest thing that is defendable. So yeah, you can defend them, which makes them fantastic. You can roll them or just add another leg. That's generally what I do when we get into these market conditions where I'm just like, damn, I don't see anything good to trade. Trade this. Because sure, we got earnings, we've got the tariff threat, we got the build threat. We've just got a lot of reasons not to be putting on new positions right now in all of the good names. And of course, we don't want to trade the bad names right now. They're not getting any flows. So that doesn't leave us with much choice. We want to continue to play something. This is better than trying to pick a direction, right? And it has some real profit behind it. Depending on how much risk you're willing to take, the closer you can get to money, the more credit you're going to get. And so you can really, you can get a couple $1,000 if you're willing to just get a little closer. But for those that want less risk, then just, take less reward and go farther out. You can shop around. That's what's nice about options. You can shop around and find your comfort level. Maybe your comfort level's at 7,200 in calls and 5,500 in puts. Great, do that, if that's what makes you comfortable. There is the notion that you can never get far enough away from price, obviously. If you're wrong and things go really bad, like COVID or the great financial crisis or whatever, if things get really nasty out there, you can never get far enough away. So if things get really bad, we would need to defend it. Otherwise, they're far enough away that, some money's better than nothing. You stay engaged, you grow your account, it's a win-win. I like it. And it's diverse too. I mean, you can do crude and copper and gold and whatever. So that's a good way to go when we're in these kind of market backdrops. Yeah, but you probably said the same thing when someone talked about futures and you said, "What are they? Ticks." I don't want to trade no silly ticks. You know this the the crazy thing is that futures used to be 1/32 too. Some of them still are like ZB. I think it's ZB, and that they've slowly been transitioning over. Um, Eventually they're all going to be that way. Even forex is eventually going to be ticks, but it's been a process. Back in the day they were trading teeners on the ES, 18s and 32s. It's crazy how much it's changed. Thank God I don't have to worry about teaching people fractions so that they can trade teeners on the ES or the NQ. Oh yeah. When we go out to eat, inevitably my wife gives me the receipt and has me calculate the tip. And I've told her repeatedly, don't be embarrassed to get the calculator out and use it. It's more important to be right than, to be vain. Just get the calculator out. And she refuses to do it because she thinks, it makes her look silly. But I deal with numbers every day, so the numbers are no problem to me, and I just go ahead and I do it. But if you if you gotta get a calculator out, get it out. Don't wreck my business because you give somebody $100 back when you should have gave them 10 cents back, right? And I've seen that happen when people try to count back change. They get it all wrong. Somebody paid for something and gave 2 20s, and all they needed was like $2 back, and the lady literally gave them $20 back. And they didn't say anything. They took the $20 and walked out the store. I, I do too. I'd rather give the money back, but like just get the calculator out, you know. And I got to deal with college students every day who want to cheat when it comes to doing the standard deviation mathematics. And it's like, yes, there are sites now you can go over there and it'll calculate the standard deviation, but you didn't show your work. You got to do the longhand, and it sucks. Nobody wants to do the longhand on standard deviation because there's a website for that, but it's the knowing that matters. Just math. It really does help as a trader to understand where the answer came from to know how to do it. But I like calculators. Absolutely. You can try to figure out where the error came in at. Uh, Jeremy threw Intel into the chat, and Intel had some moves and news today. It was showing up on the scanners earlier. So one of his strikes that he mentioned was September 19, 30 strike calls. And what I wanted to show you guys is, let's go back to Intel here for a moment. He said, check out 30, 35. Let me make sure I say it correctly, 30, 35, and 40 strikes. So when I went over here and I looked, here's the 30 strike, and it's got 30,500 in open interest. Sounds good. And today I had another 500 in volume. What I want to know is, how did we get that 30,000? And what's the open interest doing now? Is it increasing or is it decreasing? So I just took that one strike and threw it into a chart. So here's the options chart for that one strike, the 30 strike call for September 19. And we can see what the price did, which is fine, I guess. I don't really care about the price right now. I want to see the open interest and I want to see the volume. So here's the volume. And we can see when they really loaded up in those calls. April 3rd, right in front of the tariff announcement, right? Or actually the day after, because he did the announcement on the 2nd, and then this was done on the next day. Since then, however, he capitulated, and all that buying frenzy ended, and now they've just been selling out of it, and in fact, they've sold quite a bit of it already since then. And then now this is just one strike, and I didn't put open interest in here yet. That should, I guess it already was in there. Let's set it off by itself since we're not able to see it. That way we can, there we go. There's open interest. So we can see the steady climb. Even with the selling that I pointed out, they've still got quite a position in here and it's still building. So that's really good to know, right? It's one of the biggest arguments I hear from traders when it comes to options is, hey, I don't have those crazy expensive platforms with all the wild tools that you guys have. How can I do my DD? think or swim, bro. And don't get me wrong, other platforms do this. Trading View eventually is getting there. They're tying in with Tasty right now, and you can go to Tasty Trade and you can plot an options uh, in the chart. And if you can plot it in the chart, that means you could turn volume on, open interest. So we can see what that one strike is doing. The 30 strike is continuing to grow. They're not dumping it, they're not fading it, and that's cool. So that's one. I don't have to go in and copy the other one. We already know that 35 is the next one, so I can just replace the 0 with the 5. Ooh, now that one's getting dropped, right? They are decreasing in that position. And then 40 was the other one, and they're basically holding steady in that one. Let's see if we can. Okay, no, they're fading out of it. Now that we, zoomed in some, we can see that they're reducing their size here. So that makes sense. It's 40. It's the one that's farthest out of the money. Um, they are less than 25 cents now, and that it doesn't really have much room left if they were selling these to open or something. That there's not much juice in the squeeze, so to speak. And when you look at Intel, it had that rejection across the 50 period weekly moving average, and it kind of just makes you think it's ain't got nothing left. Plus window dressing into the month, into the quarter, yada yada yada. So I just thought that was a really good example of how we can use our own tools to better evaluate what's going on. This, let's just get a picture of it, is the open interest on the 40 strike. So we'll give that to Jeremy. If you guys saw chips in general, and not NVIDIA and AMD, but other ones like Intel and MU, um, they've been getting flow this week. You brought up Stock Rover. There's a couple of others that are really good. FinViz is comprehensive. Stockcharts.com, Swing Trade Bot. Uh, those are all good stock screeners. Barchart.com is another one. The one thing about FinViz is the ads. The ads drive me absolutely bonkers, but it has really good candle pattern recognition, and I love that. And then it has a lot of nuanced features that you can add to the scanning process, so that you can search only in the US with only this much float that has had a change in float over XX time with this much short. I mean, you can really nerd out on the settings in FinViz, but the advertising, unless you have a paid account, oh man, it'll just drive you crazy. Absolutely. It's Finviz also is the one that I use for penny stocks. When I want to really dig down into short float and interest and all that, I really like it for penny stocks. I think it does a much better job than Thinkorswim. And like Tasty Trade is worthless for penny stocks. If that's your route, you don't even want to go in that direction. So, distinguishing between different ones and where their value is. Swing Trade Bot is connected to the book Hit and Run Trader, and so all their scans are the reconfigured scans from the book. It's fantastic. Absolutely. Yeah, when I can, I start with PDFs if I can find them. I look around on the internet, but then if I read the book and I get value out of it, I buy the original. Because, like I said, they'll pay for themselves if they're any good. Oh, yeah. Let's look around at the volume. You actually have three volumes in your scan. You have today's volume, and then the 21-day volume, which makes sense because that's 1 month, and then the 1 year average volume so that you can compare the previous month against the year. Those are a nice combo of volumes. One, I think we could write that into a little bit of a script so that they're not three columns in the scanner, they're just one column in the scanner looking for those three things to be checked, and then if they are or not. But I guess you kind of want the number. you know Thinkorswim also has Arval in an odd way. They've got a lot of controversy over this in the previous years. I found it kind of on accident. If you haven't come across these phase scores inside of Thinkorswim, it's a button on the right side of your chart that you can turn on, and then you can make your own phase scores. So this is mine. I call it the OEC analysis, and then each one of these conditions or sections I developed on my own. So I've got just your basic information, industry, sub industry, sector, yesterday's close. And of course, we're looking at an option here. So I'm just going to replace that with Apple. All right. So it's showing us, Apple's a technology stock. Gee, you think? It's in the information technology sector. It has yesterday's close. Then I can open a price range, and I used the average daily range, and then the if it has a market maker move, I added that too. Then I added momentum and trend. I just use cam and impulse with 5-day trend or 5-day change, and two moving average combos, the 3-8 and the 8-17. One is the 3-8 play and the other one's 8-17 surge. Then volume. That volume one is the tricky one that I was getting to with this long explanation. It's R volume ratio, but they set the time. It's 5 versus 30. And they got the tiny little question mark bubble there because it's theirs. And this is the only place on Thinkorswim that I know of that they have this. And for years, if you've read, like Reddit posts and everything else where people are trying to calculate R vol and they argue how Thinkorswim doesn't have it and you can't get it, it's right there. To be fair, you don't get to choose the time, but it is right there. And they did it the right way. They calculated it the right way. The only difference is for intraday traders, if you're using the R vol, the argument still exists. If you're trying to look at what the volume was yesterday at 10 o'clock in the morning versus the volume today at 10 o'clock in the morning, there's two ways you can answer that question. From 9:30 to 10, what was the volume? Or just on that 10-minute, at 10 p.m., that 5-minute candle, what was the volume? Right? And then that leads you down a whole different rabbit hole of R-vol issues. But R-vol is a complex, nerdy thing that a lot of people argue over. But Thinkorswim does have it in the phase scores. All I got to do is just open up and search for it. I added 5-minute vol sizzle to that too. And then, of course, implied vol index, vol sizzle, and then call and put sizzle and the sizzle index. Sizzle, if you're new to the phrase, means 5-day average. So if we're looking at volatility sizzle, it's the sizzle of volatility of the 5-day average volatility. Or if it's a sizzle index, it's comparing the call's 5-day average volume to the puts 5-day average volume, and it's giving us a number from that ratio. 1.0 equals 0. So if we see 1.7, we know that we're 70% above the 5-day average call volume. Simple enough. 2 equals 1, right? That's the confusing part. 0 is actually 100% below the 5-day average. And then you just go from there. So Apple has a Bollinger Band breakout, and it is breaking out of the acceleration bands, and it is hung up on the 200-day exponential moving average, well below the 200-day simple moving average, and it's still damaged, but it's had a nice pop from that wedge that it was in on the weekly. It got back above the 20-week, and it is struggling to get through all of this trash. The 50-week is there. The there's just a lot of moving averages all piled up on the weekly, and Apple's trying to push through all of them. So it's just a dangerous time. But it shows how much strength is in Apple to push through all of those weekly moving averages. And then we've got two wick structures up there. Actually, we'll just go back a little bit farther and we'll get all of these. That's three wick structures showing that when we got into this level before, there was a lot of liquidity here and sellers were present and just sold it off every time we got up into that level. The week isn't done. They could come in again and sell it off from this level, but it's just like the pizza box. The more times you reach into the box and grab a pizza, the more likely it is that the next time you reach in there, there's no more pizza. Once there's no more liquidity here, they're going to have to chase it higher to find some. So what's going to come first? Are we going to run out of liquidity and chase it higher? Or are they going to run out of gumption, run out of fuel, and fade back away from it? That is a really nice base. Let's go. He's still on about Intel. And let's take a look, huh? We'll use the phase score that I was talking about here. Drag that up. Get a lot of information out of that thing, right? Hey, Intel is a part of semiconductors. Gee, you think? The ADR right now is about 4% a day. So it on average it moves less than $1 a day. It currently has a market maker move of 34 cents. When we combine those two together, we can see that it actually could make a $1 move today. It's already moved its ADR, by the way. It's down 0.86 and the ADR was 0.88. It has bullish momentum. Over the last 5 days, it is still down 2.3%. So if you take what we moved today, 3.8, and you look at that over a 5 day period, we were up 1.5. It seems maybe we were up 1% and then we fell. We gave back that 1% and we're down an additional 2.3%. In the CAM, which is a more complex indicator, it says that we're in a downtrend, and the impulse on the hourly says that we're neutral. But the moving averages say that we're in bullish momentum. We've got a 99 percentile in the volume ratio today versus 30, the 5 day versus the 30 day. Implied vols at 54. The vol index is at 54 and the vol sizzle is at 1. So we're at the 5 day average vol sizzle. Puts are getting hit 100% above the 5 day average. I appreciate you popping in. You gave me some ideas to mess around with the scanner with multiple layers of volume. So I got the options chain down here, only the call side at the moment, and I eliminated weeklies, so we just have the monthlies down here. It tends to be where the most volume is. It's on a daily chart. If I wanted to get more in-depth the volume, I would just go to the volume tab. This saves me a trip if I'm just looking for something particular. So I've got 5 minute volume on the options. That way I can see if the 5 minute volume sizzle is increasing or decreasing. So, is the volume from this 5 minute bar greater than the volume from the last 5 minute bar? That's basically what it's looking at. Open interest on, actually, he's looking at September. So let's just go on out to September. Calls. I need more strikes. And we want to see open interest change percent. The 26 strike has increasing open interest between yesterday and the previous day. 11%, almost 12% change in open interest on the 26 strike, which is kind of interesting. It's very likely that that's a brand new strike, and so there's a lot of changes because they're building it out really quick, right? That would probably account for the open interest being so high on the change. 40, the open interest is basically flat. 35, it's flat. 30, yeah, it's flat. Not a lot of change in open interest now compared to what we were seeing. I don't know. Intel, it's been building this base for a while now. And when it comes to price in this sort of a pattern, one of the things that I like to look for is the dominant moving average to come down and force price to do something. It set a base around that $18, 18 to $20 level, and that's the structure. And then it's just been holding out down here because it ran away from the moving averages really fast, and it needs to heal. It needs a correction. So it's been correcting since August of last year. Here we are a whole year sideways, just doing the thing, putting in a lot of work to heal. And the 50 period moving average is down here and it's just starting to flatten out, which is a really important signal. But we don't know for sure that this is the one that we're waiting on. For all we know, we're waiting on something like the 200 week. I don't think we are. So let's go to the 200 day instead, because generally, when you got this sort of a sideways behavior, it's the 200 day that we're actually waiting on. So here we are. It's that 1 year time frame, sideways the whole time, just putting in the work. We've got the 200 period having made its way down here, and the dashed 200 is what we want to focus on. The 200-day SMA as opposed to the 200 EMA. So I'm going to just turn the EMA off so we don't confuse anybody. It's that purple line. It got down here in May and it flattened out. A flat 200 period moving average is what this thing has been waiting for. It's been going sideways, correcting, healing. The 200 got down here. It's putting in its base, and we've gotten above it. Why is this important? Well, I like to use examples, right? Visual cues really seem to help people out. So this is an example of the 200 period crossover that we're talking about. The company that I'm going to use is Carvana. Just load my toolbox here. That's all those moving averages. And we're going to be on a daily time frame going back over 5 years. It outran the moving averages really fast, and then it stayed down here building a base for at least a year. And during that time period, the 200 period got caught up with us and it started to flatten out. And then we jumped it. Now, this stock had a story to tell, and it was a really great story. It was compelling. His father and son and activist investors and bankruptcy, and they turned the whole thing around. And yay, the whole hero and underdog, and beating the system. Don't really think we have that sort of a story in Intel. So they're not the same, but they have a lot of similarities. And one of those similarities is that 200 period moving average. So let me turn the 200 off over here as well. 100, 100, should be that one. Yep, that was the one. We'll just turn some of these others off while we're at it. They're not helping, just making things noisy. I think I got them all. All right. So the 200 flattened out, price jumped it, and then we need the 200 to come out of that flat state and start to go higher. Now, the 200 is a slow, sleepy moving average, and it will not curl up sharply unless price really outruns that thing. Not once either. It has to continue to do that. So when you bring up a chart and you see a 200 period moving average first having a down slope like that, really steep, and then the other way around, really steep, because that's what we want, right? If this had fallen really gradually, it wouldn't be as compelling because it very likely is going to rise back up the same way, really slowly. So now we go back to Intel. We got that 200 period moving average. It's starting to flatten out. We're getting above it. When we got above it before, back here and back here and back here, none of those were good for long plays, long term, because the down sloping 200 period moving average told us, hey, it's not done yet. There's still a lot of work to do. But things are different now. Now we're turning things around. We want to turn this back the other direction, get it pointed to the upside. See, that just doesn't look good, huh? It's still not there yet. Let's add some time to this. Yeah, see, some of the pieces are missing to the story. We didn't get that big fall from grace like we had in Carvana, and then the base and the run. I'm tired of jumping it back and forth. Let's do it this way. All right, there's Intel on the weekly chart. There's the beatdown. Then it tried to run, rejected the halfback at $50 and got beaten down again. It fell 50% from $50 to $25. And sure, this beatdown is pretty good. And from August to August, there's our base. But that 200 just barely flattening out. I think we've got more work to do. I don't see this as a long-term play yet. Hopefully you can see how the pieces aren't there compared to Carvana, and they will almost always be the pieces that are supposed to be there, right? Take PayPal. Notice the distinction, like right away, it looks a lot like Carvana. Big, steep fall, lots of time to base, let that 200 period come down, start to get it turning to the upside. And we didn't even get a good turn up yet, not a really good one. Price wasn't able to sustain it and it fell right back down through the cracks. It was a false start. And this is one that, I mean, I'm not the only one who's tried to trade this. It's still failing to work, right? So it's trying again, it's fighting the 200. We've got things moving in the right direction, but it's been working on this now for almost 2 years, right? It's been a slog from, yeah, mid 2022 all the way to now. And we're still not coming out of that yet. Take it back to Intel. It's not ready yet, right? Could we get along? Sure, yeah, we could probably get back into 25, maybe retest this high up here because that's a gap that needs closed. Sure, but is it the comeback kid? Nope. I don't see this as a Phoenix play, which is what we call those, you know, rising from the ashes of the Phoenix. Sure, you guys have heard that one before. This ain't it. It's not what you would want. We did get that new high in the ES, didn't we? And we got it with 1,000, with a 750 tick. Very nice. Getting a little extended from VWAP though. NYSE's outrunning everything. That's not what you would want, right? You want that green line leading the charge. When it's NYSE, it's usually stocks up, vol up, which is forced buying and grinding higher. Tricky ones to play because everybody tries to short that. Yeah. How many of you guys were trying to short this all afternoon and getting your butt handed to you? Stock up, vol up generally tricks traders that way. Nasty. Notice how we gave up the green line on that run. We had green line leadership into lunch and then we lost it. And we had leadership and then stock ball, forced stock ball correlation. Eh, whatever. Still got 30 minutes, but I don't like BWAP as much now because you can see it. So Intel. Sorry, I saw a squirrel. That gap is probably the best gap we have to target on the upside. We already closed this one, so that's done. I think that might be a gap, but it's so small that sure enough, that's a gap. And this is a gap too. We'll take this. Oh, we already hit that one. All right. So that gap is done. It's off the table. That one's done. It got hit by that big bar. It's off the table. So that just leaves us with this $26 basically on Intel. And we're at 22. So, you know, we could get a couple dollars if we can get a stretch above the 200. And at this point, we would be looking for probably a little bit of reciprocation, right? We got $5 underneath it. We could get five above. So from call it 21, we could get to 26, maybe even overshoot into this 27 and a half. That's another gap to close, by the way. So if I was trying to play Intel, one cheap way to do it would be butterflies on these strikes. And since it's cheap, we should have $1 wide strikes. $250,000 calls against 138,000 puts. The sizzle on both is almost 100% above the 5-day average. They are hitting most of those calls on the sell side. That's not good. They're hitting most of the puts on the buy side. Yeah, that's not good either. They're buying puts and selling calls, yo. But it could be like Jeremy said, maybe they're rolling, right? And if they're rolling, then they're buying back their short puts and they're selling their long calls. The question is where? So let's tighten this up and then we're going to do the roll thing. Somebody told me the other day this drives them nuts. I'm really sorry about that. You just close your eyes for a minute. What what I want you to watch when I do this is this part of the screen, right? I know it kind of goes fast, but for me, I do it all the time, and so I'm just used to seeing it. There are a lot of strikes or a lot of expirations, and I want to see all of them, right? And I don't want to sit here. If you was, in a hurry trying to get a trade on, you wouldn't sit here, 30 minutes scrolling through all this nice and easy. So I use the speed wheel and I can just shoot through it really quick. And if something stands out, like right there, I see it. So I look at one side first and then I go back the other direction looking at the other side. I'm looking at puts. These stood out for August 15. That was really all there was is August. Now on the call side, already 25 stands out for December of 2027. That's a long ways off. What else we got? Uh, 40 strike in June. That stands out a little bit. Some volume today. And then, oh, that's June of next year. Then we've got 25 strike in January and 22 strike in January. Seems like they're really going out there. 21 strike in November. 22, 25. That's a recurring theme. 22 and 25. Here again, 22 and 25. So they're building out the 22 and the 25 level. Look at that. 10,000 today. Now I got to chart that one. Okay. Well, that really makes me think that we're going to come in tomorrow and see that one gone, right? Just gone. The 60 strike has a massive amount of open interest for January of next year on the call side. This thing's acting goofy. Think or swim. Sometimes I just want to choke it. There it is. January 50 strike, 81,000. So I swapped it over to volume. Look at all that volume. And sure enough, the 22 strike has a massive amount of volume. $33,000 options traded on the 22 strike. They didn't run it as a spread either. They bought it and then they sold it, or they sold it and then they bought it. Looks like they got their butt handed to them. They sold it at 45 and bought it back at 74. Oh, they felt that. And then they sold it again. At a different strike. Got a lot of different expirations here. It's muddy, muddy water. But from technical analysis standpoint, while this could eventually turn into a Carvana or a PayPal or one of those guys, this comeback kid Phoenix play, the 200 needs to start to rise up. So we want that curve, and we want to see price holding above it, which, simple tip, you won't get the curve if price isn't holding above it, right? If it's one Mick Jagger shot to the upside, then you won't get it. It has to be a sustained drive above the 200 to turn it to the upside. We don't we aren't even holding above it yet. So that's step one. From a short trade or a long short term trade, not not putting on a short. Then we got something like an angled trend line that we could play. I mean, you don't have to, get that spot on perfect. It's not really the goal. You can see how it lines up with the 50 period moving average, which we are above. It's a good start. So we could look for a 50 period bounce, or we could just look to stay above the 200. For today, look at how it's going to close on the day. We're underneath the midpoint on the day. That's a really bad place to close. If I'm looking for a new trade, say watching the clock, I'm looking at where we're going to close. I want this to close above that 50 on the day. And it's just the 50 of price, right? Not a 50 period moving average or anything like that. Just where's the half back? Because from a bullish perspective, I don't like price action that closes underneath the midpoint for a long trade. Now, me, I'd rather, buy calls when we're falling to play a long trade, like I did in Apple with those 8-cent calls. I bought them when the stock was falling, but I had a daily chart reason to go long, not just an intraday falling price, right? So when we go back to Monday and look at what we had that dip below the 20. We closed here, we opened here, and we fell and dipped below the 20, and then we come running back up. There was dark pool prints down at that level, and we were trading that, and then we had this signal, right, that we were holding above this 20 period moving average. So I had reasons to try the long besides price falling. I did not mean to do that. Let's try that again. So if you had tried the same thing as I did in Apple, you would have wanted to buy the call back here when we were still falling really hard. You don't want to try to buy it here when we're running back up. In theory, later in the day, you could try to buy the call here when we're falling, but I don't like trying to buy the call here. And especially now, right? When everybody who's been getting whipsawed is trying to get out, I wouldn't want it now. This is not where I want to get calls. So I don't have a play here. Now, a butterfly or something like that, crazy cheap. Sure, why not? Because it's a butterfly, it's 2 or 3 pennies, 5 pennies. I'm down for that, but I wouldn't spend a couple $100 buying a call in this. It's still broken. I do like this base though. 1 year in a base like this. When it does finally go, it's going to be a fantastic play someday, eventually. Problem is, I don't think we're there yet. There's your trend line breakover. There's the halfback. So with this trend line breakover, we could make it to the halfback, maybe. But I mean, we don't even have an intraday momentum. We don't have options in our favor. Yeah, we don't have anything. Sorry, I don't do good typing and talking. I had to stop to choose one. I'm horrible at it. Just really, really horrible at it. It does. And with a short week and a short Thursday, I'm you know what I mean? Like most people are gone. I, I was surprised that anybody came today, which I'm glad you guys are here. It'd be really boring talking to myself, but there's just, it's just nothing out there. Did you hear me talking about Intel? So I compared it to the Phoenix of like Carvana and PayPal, because it kind of matches that a little bit, but it doesn't have the recovery yet. And after a year of going sideways, we don't have the oomph, the push. I like it though. Definitely going to keep it on my radar. And we did get a trend line breakover, but I was looking at how we were going to close today. This daily bar isn't even going to close above the 50% point on the day. Oh, nice. These guys were in the news too, and they were getting attention on Thinkorswim's trade flash from first thing this morning. They were getting headlines down one and a quarter, and then they reached 5.2% at low a day. I think maybe it was a little lower than that. Pretty close. I mean, they were down, 5+% today. I like this one a lot. The the 22 strike is getting a lot of attention, but it's really sloppy. Like they bought a bunch and then they dumped it and then they started buying it again, but they spread it out across a lot more expirations. The 22s are getting hit. And then there's some really far out in time stuff like 2026, 2027 with big flow today. Like impressive flow today for being so far out in time. I definitely think that after a year of sideways, this thing is ready to make a move. It just doesn't seem to have done that yet. You see that guy in the chat asking about that high of day large cap scanner? Have you heard of that scanner? I don't know where it's even from. What? I was thinking maybe it was a bullish bears thing because he says it like we should all know what it is, and I'm like, I don't know what that scanner is. I've seen him quoted a couple of times now, and I'm like, I don't know how to answer it because I don't even know where you're reading it from. You got big plans for the long weekend? Nice. We were supposed to go to the races, and they were going to put on a big fireworks show after the races, but there's been a lot of rain, and so I think our races are going to get rained out, and that means no fireworks at the races. Yes, I don't know what we're going to do now. It's a dirt track race, so water on the dirt track race doesn't really pan out. Yeah. They dig a hole sometimes on turn one just from sliding sideways, like drifting. Their tires will start to dig in and like start to dig a trench. And man, halfway through heat laps, they're getting beat down. You know their kidneys are just killing them. Oh, that's so hard on the kidneys. I did put my Hike and Ashy scanners in the chat for anybody watching the replay. You could just type in those words and it look in the search bar in the upper right when you search HA scanners. You should be able to find it. These are for Thinkorswim. I don't have any for TradingView. Um, there's other platforms I believe that you can scan for HA stuff too. These are modified Thinkorswim indicators. They're not custom because Thinkorswim doesn't scan for HA on its own. So just, be mindful of that. And as always, Hike and Ashy, even though we call them candles, they are not candles. They are price action indicators only, not real price. They'll they'll completely lie to you. So don't read them like a candle. That's my biggest complaint with them is I've seen traders get hurt and they're like, "Well, I was reading that," and like, yeah, then that's not price. It's so sneaky. I did hear today. I had not heard that before. The wicks on Heiken-Ashi, we would read them completely different than how we read price, right? So I'll bring up the chart. I have Heiken-Ashi on this chart right here. So if we was reading regular price action and we see wicks, it implies like intraday reversal or intra-week reversal, depending on the time frame of the chart. That makes sense, right? Because that's how we read price. So me with my bias being a price action trader, when I've looked at Hike and Ashy and I've seen big wicks, I interpreted that as a reversal in price. That we went a particular direction, say down, and then we reversed and we went back up and we left the wick behind. But what I was watching this video on Hike and Ashy today, and the argument is it's Hike and Ashy, it's not price action. Don't bring that bias to the table because that wick is not indicating reversal per se. If it's a big wick underneath price, it's pointing you for that price to continue to go lower. If it's above, then it's pointing you that it should go higher. Now, I don't have anything to back that up yet because I just heard about it today, but they did reinforce what I continue to tell people is don't read hike and actually like price action. So me bringing my bias about wicks to the table doesn't make sense. I shouldn't try to read these wicks like I would read price. So I have to do some work this weekend and try to figure that out. But they really just kind of sat me back in my seat and made me think I'm carrying my bias with me, even though I really wasn't trying to. That's the thing about bias, though. We carry it around whether we like it or not. All right, well, that narrowed it down. I think you're right. He said it came from the next level library, and I didn't make the video. I'm almost positive, which means it's very likely Tim. But at least now we know where the heck it came from. I remember Creed did some HA videos. Um, I don't remember him ever talking about Wix though. But to be fair, I was multitasking and not really paying that much attention. That's true. He like fell off the cliff on Ranko. I've talked to my coaching clients about it. Usually when they say they want to learn to stay in their trade longer, I'll recommend that as a way to like, hey, once you're in, swap one of your charts to Renko and then keep an eye on it because it'll help you with whipsaws and getting faked out. But inevitably, they always end up telling me that, well, I was using it for that, and then I was using it more and more, and now it's like the dominant thing, and my win rate went in the toilet, and things aren't working out. Yeah, I don't use it. I remember I tried. I was using it for scans and hunting for opportunities for swing trades, and then I just gave up because Thinkorswim does not do a good job with that. And I never went back to it personally. I just don't find value in it. But another funny one when we're talking about just weird stuff that causes people problems is stock traders who trade futures. I've heard from a number of stock traders that say, I have no problem trading stocks. I'm killing it. Look at my portfolio. And then they say, but I go to futures and I get my butt handed to me. And it's like, price is price. What are you doing wrong? And I've heard it from enough people now that I know it's a real thing. I'm fine. I'm not having any problem, but I'm really diverse in how I trade stock, right? I don't just do one kind of stock trade. So I don't know if anybody else is having those kind of issues or not, but I've heard it from a number of people who say they can't seem to do both. It's kind of odd. If you guys are stuck with that issue, um, one of the things that I had talked about with the people that had brought it up was when we trade stock, we tend to give it a little bit of room. We're willing to take some heat, let the trade work out. We've got a defined idea of where the trade is no longer valid, and we think, oh, I'm wrong. I need to go ahead and get out. But with futures, we give it almost no room to be wrong at all. It seems like we want it to be immediately right or else, and we cut it. We don't want to take any heat. We're not willing to, give it any time to bake in the oven, nothing. And I really think that that's the discrepancy between those two approaches is, with futures, most of the posts that I see in the chat is that thing has to immediately work or I'm out, I'm done. Or the other side of it, that giving it so much room that your stops like pretty much don't exist at all and you're taking massive heat, and then you end up with just a little bit of gains because you're just grateful that it came back to where you got in and you take a little bit of profit. Well, that's not going to work either. You end up blowing yourself out of the water doing something like that. So, if you're having that sort of issue, consider what you're doing as a stock trader, how you're evaluating the trade. And I think what you'll find is you're just not giving them both the the same approach. You're being much more strict on the futures. And that's a high bar to have a trade work immediately or else, right? And It's doable. There's nothing wrong with it. But if you use that on one, you should probably try to use it on the other, and you'll get more normalized results. So when we come back next week, we should have an answer to the big, beautiful bill, and we should be hearing some solid rumbles about the tariff deadline because that's the 9th for the deadline. And we were supposed to have almost everybody signed up at this point. We don't have that. We had possibly two, and those two wasn't done yet. It is interesting that the market seems to have been ignoring this latest deadline because of the whole taco thing. What if he doesn't chicken out this time? Or does or he does what he did in April 2nd. Remember, he did apply it on the 2nd, and he's like, "Just suck it up and take it, kids. You know, take your medicine." And then by the 9th, the bond vigilantes were just kicking the door down, and he's like, "Oh, okay, okay, okay. Just kidding." I want to see if he's actually going to go to war with the bond vigilantes or not. So, we're going to be open for half a day tomorrow. It wouldn't hurt to perhaps shop around for something really cheap, long or short. And Spot Gamma made the recommendation that you could use SMH rather than SPY or QQQ. This is going to trade very much like SPY or QQQ, right? So it's not lockstep, perfect tick by tick, but these options are a lot cheaper. And if the S&P crashes and burns, so will this. If the S&P, gets a massive face rip to the upside, so will this. So if you are thinking about, a cheap lotto into the weekend and you want to dabble a little bit, SMH, I think, is a really good proxy. Um, all credit to them, right? I didn't think that up. And to be fair, this is always their proxy whenever they are in this situation and they're like, "Oh, you want to play along with a lotto? You should use SMH." So, it's not the first time they've ever recommended it. And I've done it before. It works okay. But if we don't get the big move, you're not going to get anything, right? So just consider that if you do try to go, like far out of the money and spend two pennies, um, just expect that money to be gone because you're either going to get a win or you're going to get nothing. There's not going to be any middle ground. Exactly. So, it's a good way to wrap up, I think. Speaking of asymmetric risk, I was working on visuals, and I want to I want to recreate this. I've got all kinds of doodle products, so I'm going to be making this small risk, big reward, but it needs some flair. It's not done yet. Yeah. I've got all kinds of doodle products, so I can do it. But you use Gemini now? Sounds exciting. Do you see my AI trade list that I had posted in the chat? I started allocating in February, and the five stocks at the time that I were using is I just reposted them in the chat. And to be sure they didn't all work out as good as I would have liked, but I didn't want the overcrowded trade that everybody and their brothers in. I wanted something a little off path, a little smaller, and this was the route that I took. It's been okay so far, you know. Yeah, yeah, it's a little off the beaten path. Which one? That's definitely off the beaten path. Yep. Now that's more of the Phoenix too. The beat down, the turnaround, and I don't see stock splits and a bunch of other shenanigans on there either. You posted this one in the chat the other day, didn't you? No, GPUS. Yeah, I thought I recognized that name. What caused the pump on that. The This does look like window dressing, like you said, into quarter, shorts cover. Yeah. Well, guys, let's uh let's wrap it up here unless you guys have questions. And remember, we got a half a day tomorrow. So if you're shopping around, you got a little bit of time left to do it. Hit me up if you got questions. The guy in the chat who's been asking questions, he's not in the stream. Hopefully we can get him in here and get him sorted out. But we're here to help you guys out. So when you have questions, bring them to us. There's no such thing as a silly question, just the silliness of not asking it. You got us here as a resource. Take advantage. Absolutely. I've done that before. Learned something just because somebody wanted to know it. Heck yeah. With that, unless you guys got questions, I'm gonna wrap it up and we'll see. Wait. What's this? Meta. Oh yeah, absolutely. Absolutely. All right. Short-term outlook on Meta. Let's start with the double top and the fact that it overshot with a gap up breakdown. So fake breakout, fast failure should bring it back into the 20 period moving average. But we've got the higher highs and the higher lows, and the trend is not broken. So until it breaks the trend, it's still in trend. Now, when you start saying short term, that could be like until earnings, because that's right around the corner, right? We got those sneaking up on us pretty fast. The um, the earnings for this is at the end of the month, so you got 28 days. And when when it comes to earnings, a lot of these guys will run into earnings like a ramp or they'll fall out of earnings. This has been running since earnings. We got to make the assumption that the run is done and it's going to consolidate from here and or it's going to fall back from here as it gets into its earnings. So um, I would play call credit spreads and use those to buy some puts or do like a put calendar maybe. I don't really like the calendar, but you have the differential in the volume, not volume, in the volatility that you could benefit from that. Calendars always do good with earnings. You would just be farther out, right? You'd be using like late August and September's options, and that doesn't really fit your short term question. So short calls does make sense. The threat is the tariffs and uh, the big beautiful bill, because the tariffs are going to go to the heart of this discussion with Europe and how Europe is taxing our companies like Meta. That's the name they keep saying over and over. Meta, Apple, Microsoft, Google, they're all getting part of that tariff talk with Europe, and news on that could give us a hard spike to the upside and break that double top, and that would hurt your calls if you're short in those. But I like short calls here. The trend is not broken, so that you're not talking about long-term short calls. This is a beautiful trend. Higher highs, higher lows, fanned out, moving averages, everything is fine here. So short-term short just until after earnings. Yeah, absolutely. If I wanted to do it the cheapest way possible with the least amount of risk, put butterflies scattered into different spots, like 750, or not 750, we're at 713, 650, 600, somewhere around that 200-day moving average. Putting some really cheap out of the money butterflies out there. I'm talking like 2 or 3 pennies. You know what I mean? And for a wide butterfly, too, I bet you could get them pretty cheap. And what do you care? You can't even get coffee for $3, right? Your commissions are going to be more money on that butterfly than your actual risk. And I think that'd be the cheapest way to go. Or bring the ratio in, right? And instead of having a 132, put in something like, or instead of a 121, have a 132, which would change your ratio, or bend the wing a little bit so that you've got one that's offset. That would give you a chance to build something like what I'm about to build here. Let's use, where's that earnings? Yep, that did it. This is let's just call it August 1st. So we want something in front of August 1st. The Yeah, we'll use July 18 just because it's probably got the most volume. And we want something like a broken wing butterfly or a ratioed fly. So let's try an at the money unbalanced butterfly. Put that into the risk graph. We get something that looks like this. So as long as it stays under 718, this trade is good. And if that feels a little risky to you, you can just move everything one strike up. So you'd be using like 730, 720, and then 715, right? Move all those strikes. But this will give you $2 in credit with a peak of about $700 if we run into that 715 area. So it gives you room to the upside if you need it, as long as we don't go too far to the upside. It needs to close under, let's just say 718, just for a nice round number. As long as you close underneath 718, you're fine. So that's a $5 window and $2 in credit. And of course, you got that credit, you can spend it somewhere. That's one way to go, but that has a lot of risk in it, right? That's 200, well, not a lot, really. $288 on the upside. And if you try to push this higher, you'll lose your credit. Not all of it, but you'll lose a reduction in credit and the risk will get bigger. So you have to think about that. On the other hand, if you just want to buy some puts, then a put butterfly, I think 700 is probably a bit close, but you could go with say 650, or if that doesn't price well, 625, and just buy some way out of the money butterfly. Yeah, $6. Now that's not wide yet. If I widened it out, probably going to be around $30 or so. The wider position means you're more likely to land inside the tent. As $25. We kept it under $30. It's $10 wide. You could probably go out to like a 630 or a 625 and get the butterfly, and they're so cheap, that's $2. Scatter those things around out there, spend $2 here, $2 there. Any move to the downside at all will land in one of those butterflies, and they'll pay you really well. That's a $5 spread for 2 cents, which means your max profit is $4.98. Although we would never ever say you're going to get max, but you could get half a max, $250 for risking two pennies. Oh, I have hit bullseyes. The the thing about bullseyes with equities though is you got legs in the money at that point, and now you're playing chicken with the close, trying to get out of it and get your profit. So you can get max, close to max, if you're holding it, into that last day. It's still scary. Here's a $20 wide put butterfly for $35. That is nice. I might get that myself. Now, the thing about Meta and its earnings is this thing is a crapshoot when it comes to earnings, when it actually reports. But you don't want to be in this thing when it reports. That's why we're looking for like July 18, get out before the earnings date, because whew, Meta has taken some beat downs over the years on earnings. It's nuts for sure. On the question about options trades, this is not a bullish bears video, and this is one of a few that I made. Um, I just I made them in a series. I threw them out there, and they're just day trading tips. So, you know, from the first video, if you go to the description, it links to video number two. And then from video number two, just go to the description, it links to video number three. And you can go through the series. They're just little tips and tricks for how to day trade options. See your price quickly, recognize your exit targets using percentages, how to read the options chain fast as a day trader instead of fumbling around and really struggling with the numbers. Just it's just tips and tricks, right? This isn't like what are options 101 and you know just tips and tricks. So check that video out too. That'll help. Did you see their stock? Yeah, the home builders are getting a little bit of a leg up with mortgage rates hitting lows. They uh they they, they crawled back above the 200 day. We just got earnings on the 1st of August, and then we got to get through that halfback around $16. If 20, then 40. This thing could double by the end of the year. So if 20, then 40, if 40, then 80, if 80, then 100. I know it sounds silly, but that is how it works. So, keep your eye on this one. They struggled with 20 the last time. That's why they struggled with 20 the last time. They got there, they took their beat down, and they took a 50% haircut from $20 to $10, and they're struggling at that $15 mark. If these guys get back to 20, they're going to 40, right? But they got to get into 20, above 20, and get a good weekly close above that $20 level. Rocket Mortgage. And there's other ones that play with this one too, right? Like Open, I think it is. Is it Redfin and Open? Ooh, yeah. Damn. I didn't realize this thing had taken such a beat down. I, yeah, I took my eye off of it at like $1.50, and I haven't been here for a while. Damn. Really? Yeah, I'm going to be looking at Open a bit more next week. About the margin question or the uninvested cash, if you get more than 5% from your broker, you're getting it. Interactive Brokers is paying like 4.8, Weeble's 4%, Public's 4.1, Robinhood's 4%. You know what I mean? Like you're if you're getting 5, you're doing the thing. IBKR seems to be top dog right now. I will definitely look that out. Oop. Well, I appreciate the heads up. I'm going to dig into a couple of topics this weekend, including HA. Yep. Everybody have a good week. I will see you all in the morning. One more day.